Welcome to the April 2026 Greatland Resources livestream town hall meeting hosted by Ticker TV, where we collect your questions and put them to Shaun Day, Managing Director at Greatland Resources. Shaun and the team continue to de-risk the business and have delivered some significant milestones since the December 2025 town hall. These include a 150% MRE increase to 8 million ounces of gold at Telfer, which has put to bed all thoughts of Telfer as a spent asset. The O'Callaghans Tungsten MRE proved to be globally significant, which came as a pleasant surprise on the upside, as did the excellent March 26th quarterly update. At the 31st of March, Greatland had cash of over 1,200 million Aussie dollars in the bank and no debt. Thanks for all your questions, which I'll put to Shaun in a moment. But first, here's Shaun with the latest Greatland presentation. Shaun, over to you.
Thanks very much, Donald. Appreciate you putting together another event for us and for those people dialing in, and of course the questions. With the presentation, look, I'll try to keep it quite brief, and that way we can spend more time going through those questions that Donald's been able to collect. With that, look, the disclaimer is available on the website, but let me just kind of walk through the overview of Greatland, where we have this confluence of this cash flow producing Telfer asset, world-class significant infrastructure, and this development asset with Havieron. You would have seen the quarterly result recently completed for the March quarter, just over 82,000 ounces of gold, another 4,000 tonnes of copper, and that takes us to almost 250,000 ounces in just the last 3 quarters. Importantly as well, you've seen that cash balance continue to build up to over $1.2 billion, and of course we're debt free. And what's important about that is that underwrites our ability to execute our growth program. Telfer itself is this marvellous infrastructure, Australia's 3rd largest gold processing plant. And what we've done with the resource update is demonstrated the longevity of this life at Telfer. And of course, the highest value you get from Greatland is if both Telfer and Havieron are operating together. And that leads us to Havieron, this world-class development asset. Of course, as people understand, it's partly built, but we are waiting on final environmental approval, EPA approval before we recommence full operations there. But we are slowly ramping up activity there right now. And of course, when Havieron comes online, it's a considerable development, but the grade is around 5 times higher than the grade it displaces out of Telfer. So we think when this is online, it's a lower cost ore, it's a higher grade ore to deliver growth in terms of ounces, and of course that potentially transitions into additional free cash flow generation. In terms of the asset, the company itself, we're listed in both London here and in Australia. We think both exchanges are operating really well. They both have strong liquidity, and we remain really grateful and respectful of the support we get here in London. And we've got a great universe of research coverage, both here in London and in Australia. And what we tried to do with that Australian listing is get that traction into the Australian market, get that indexation, and I think that's what we've achieved, and you've seen the growth in the stock. And that growth now, we are Australia's 3rd largest gold miner. We started modestly mid-pack. There's the 2 big units there, Northern Star and Evolution. Some of you may be aware, I spent much of my career at Northern Star as we developed Australia's largest gold miner, but it's a tremendous achievement for Greatland to now be Australia's 3rd largest gold miner. And I think this table tells the story as to why we've got that traction and why you've seen that growth. And this is, across that sector, the cash flow generation, the profit margin per ounce. And as you can see, we're top of the pops. We're generating almost $2,700 per ounce produced, that is best in class. And that's a great credit to the team in terms of we've been able to participate in that high gold price, but we've also continued to put downward pressure on that cost structure, which has generated that positive. In terms of Telfer itself, I mentioned it's this big asset, the third largest, and those two bigger assets, Boddington and Acadia, are both owned by Newmont, the world's largest gold miner. So again, in our peer group, we are the largest processing platform. And then this slide, I think, tells you the advantage of that. We really operate in that bottom right-hand corner in terms of large volume of ore processed, around that 18 to 20 million tonnes, and at a lower cost. The unit average for the sector is around $34 per tonne processing cost. We process ore at around $18. So we really have a quartile all of its own. Even if you only ran one train at Telfer, you'd still be the fourth largest gold processing plant in Australia. But of course, as we've continued to invest in the drill bit and demonstrate that resource, we have more and more confidence that we continue to run this asset, both trains at full throughput. I talked about cost improvements before, and this is the efficiency that we've delivered across the site. If we look at that underground, we've increased productivity around 49, almost 50%, measured by total material moves. So we've taken that from about 4.4 million tonnes a quarter up to 6.6 million tonnes in a quarter over the last 12 months. If we look in the underground, it's even more dramatic. We've moved from around 175 metres of monthly development to over 450 metres of monthly development. That's around 250% improvement. We've also improved the processing. When we look at processing, we've taken gold recoveries from around 81% up to 88% for the last 2 quarters, and we think we can sustain that north of 85% into the future. In terms of copper, it's been slightly more dramatic, where we've taken it from 71% up to 79, almost 80% recovery. And that is huge, because what it means for the activity we're doing at site, we're generating more payable metal. And all of this, you can see translated into that upper right-hand corner chart, where you see the all-in sustaining cost. And this goes all the way back to 2022. You'd expect to see some inflationary creep. You'd expect to see that all-in sustaining cost just walking up over time. Rather at Telfer, notwithstanding we're even producing a slightly smaller number of ounces, we've actually been able to take about 1/8 of our cost structure out, and you're seeing that reduction in costs. And that's generating this positive jaws, where we're creating our gold price received is higher and our cost is lower, creating a bigger margin. And we've done all this safer. We've taken the safety TRIFR at site from about 10 to 12 a year down to 5 to 6. And in our 15 months of operation, 0 significant injuries. So again, the fact that we're achieving this increased productivity and safer is a great credit to the site team. And all of this allows us to invest in this growth cycle where we're investing across the business, in the open pit, in the underground, in the infrastructure, to create a sustainable long-term outcome for shareholders. This really is manifest in this resource update. When we bought the asset, it was famously had a short life. But we saw the opportunity through due diligence to reinvest in the drill bit and reinvigorate Telfer and demonstrate that life. We acquired it with around 600,000 ounces of JORC resource. Today we have 8 million ounces, just 15 months later. That's an increase of around 12-fold. That is remarkable. Combined with that big resource that we already have at Havieron, it means we're 14.9, almost 15 million ounces delineated across 550,000 tonnes of ore. That resource ore of 550,000 tonnes feeding a 20 million tonne per annum plant gives us this opportunity to demonstrate a very long life at Telfer. We already have that 17-year life at Havieron, but similarly, this gives us the opportunity to not just demonstrate a 1-decade life at Telfer, but that and beyond. And of that, around 68% of that was either measured or indicated JORC resource. All of that is what's available to come into that reserve update, which we intend to do in this quarter. So by June, we'd like to update the bottom part of this slide with a new reserve table. And where does this, in terms of a schematic of Telfer, how does this look? People are aware the centre of gravity of our operations are in that Telfer open pit. That continues to be our focus in that West Dome open pit area. We've been doing a strip of the stage 7 area. That becomes our base load feed into that mill for June 27 and June 28 years, the next, say, 24 months or more. And then also we continue the underground mine with that main dome underground. That does about 1 to 1.5 million tonnes per year. But then there's the growth opportunities. When we look at this, we see the continuation from the resource to continue to drive the West Dome open pit, continue to drive that main dome underground, but then add additional potential mining areas. We have Havieron, but also that West Dome underground. That's the highest average grade we've seen at Telfer since its 2005 restart. It even is a shade higher grade than Havieron. So we're really excited that comes up through the existing Telfer infrastructure, in through that underground main dome infrastructure of the underground crusher and the hoist to surface, which directly goes into that mill. We have the opportunity to move to, Telfer from one relatively modest size underground, that main dome underground, to say 3 or even 4 underground mines. Turn on the, continue the main dome underground, bring on West Dome underground, which potentially even beats Havieron into the mill. Of course, we want to complete that Havieron development, which is incredibly important. And also on that top right slide, you can see that red shaded area sitting below that old sub-level cave. We've also got the ability to turn back on that sub-level cave. That vertical stockwork there is fully drilled out and creates a potential for us, again, to leverage that embedded infrastructure, that latent infrastructure, which can hoist over 6 million tonnes for crush and hoist to surface over 6 million tonnes. So all of these come into play, and what we want to achieve is change the proportion of high-grade underground ore going into the Telfer mill, continuing to also run the open pit, but the more of that underground ore we're able to blend in, that should lift our ounce profile and ultimately deliver additional free cash flow for shareholders. This really just captures this in the in terms of the Telfer overall, but just it shows you that surge in exploration up in that top right-hand corner, where we saw this opportunity and we've taken exploration to 240,000 metres of drilling. That's our current cadence. We've gone from 2 rigs at site to 11. So that's a huge uplift in the investment, and I think we'll intend to continue that cadence of drilling probably right out to the end of this calendar year. So that 240,000 metre drilling program probably ends up closer to 360,000 metres of surge capacity. And that will continue to allow us to demonstrate these life expansion opportunities at Telfer. And if we just look at that main dome area, that big blue halo around that stage 2, it's a huge volume area. Similar grades, similar strip ratios, more of the same. At a strong gold price, we think that's really attractive for us. But even also re-drilling that main dome pit, that hasn't been active for around 8 years. There's mineralisation in there. There's already some small delineated kind of ounces there. But what we see as well at today's gold price, which is virtually doubled since they stopped mining there, We'll probably put a couple of rigs on that main dome in the back half of this year. And although we don't expect to start mining that, I think we have a lot of mining ahead of us in the main dome. Having the contingency, having the flexibility of different mining areas is always advantageous. Open pit, we think, is beneficial, just like ultimately moving to 3 or 4 undergrounds, we think gives us that same flexibility and resilience in the organisation. Just turning to Havieron, which I guess has been a huge part of the journey. The feasibility study you would have seen in December 25 upon announcement. This is a world-class asset. Once ramped up, generates around 266,000 ounces per annum, plus 10,000 tonnes of copper over a 17-year period. And there's a large amount of ore sitting outside that mine plan, which gives us the opportunity to extend it well beyond that initial life. When we look at the economics on it, absolutely compelling. This was last done in December at just over 6,000 Australian gold price. It's around $500, $700 higher today. So again, some of those economics in terms of payback, in terms of IRR, are actually a shade better. And of course, this will be one of Australia's lowest cost gold mines. This is all part of that overall narrative around Telfer. It's this coming together of a world-class development, Australia's second largest gold development, but higher grade, and then with that existing infrastructure at Telfer, leveraging that infrastructure for a relatively low-cost delivery of Havieron. And this is kind of where I talked about that grade. You can just see the size of the development there, the reserve base, and where that grade sits relative to other development assets. So we're really excited about the opportunity that we have at Telfer, and we think we're advanced with the EPA, but we think that's a really important announcement. Confident it will happen this calendar year. And when we do that, that really fires the starting pistol in terms of delivering that and people having an understanding about when that augments the operations at Telfer. This is just what, more of that feasibility study. I think one of the really interesting aspects to this is a reminder that that Havieron feasibility study was done on a completely standalone basis of Havieron. Just 4 million lonely tonnes going through that 20 million tonne mill. That meant that our processing cost was around $38 a tonne, as opposed to the current $18 a tonne. Now, a reminder that we do grind a little bit finer the Havieron ore to get that higher recovery, so that's a higher energy input. So it's probably always going to have a cost slightly higher than that $18 a tonne processing cost. But even if it came out in the middle, around $27 a tonne or similar, I think that's a huge additional benefit, and again, puts downward pressure on the cost of Havieron if you believe Telfer continues to operate. That equally applies to shared overhead costs, shared sustaining capital. It actually makes Havieron look better, it makes Telfer look better when done together. And this is that mine at Telfer. Just a reminder, there's already a significant amount of work. That main decline is already 320 metres progressed, so it's really rare you start a new mine with that kind of head start. We continue that main decline down into the Havieron ore body, but then we also, in parallel, start work on that second conveyor decline, which is more of that red straight line down to the ore body. And that's what allowed us to reimagine Havieron and take it from, say, a 2.8 million tonne per annum asset to a 3.9 to 4 million tonne Havieron, and take advantage of that big Telfer mill. Just as we wrap up, I think this slide is probably, or at least that chart in the bottom left-hand corner, has got to be one of my favourite slides in the deck, and that's just that free cash flow generation. A record quarter of free cash flow generation in March, 260 million to take us to $1.2 billion of cash, again, no debt, but we do have a 7-year undrawn 500 million facility this gives us already $1.7 billion available cash to deliver that growth program, to deliver the just under 1.2 billion Havieron, but also deliver the West Dome open pit cutback, deliver the West Dome underground, and bring these other really attractive investment opportunities to grow Greatland. And that's, before I will just jump across just briefly before I line up, just to also just touch on the announcement of O'Callaghans. This had some interest, and I think we might have some questions, but I think seeing this chart probably does give a context to it. Tungsten, O'Callaghan maps as one of the 3 best tungsten assets in the world. Mactung, which is a Canadian asset, I think prints very strongly, and then Shandong, which is South Korean, and O'Callaghans. Shandong's in development. Mactung is also kind of in development, but I understand going through approval process. And this actually almost undersells O'Callaghans a little bit because there's also a base metals, principally copper, there, which adds to the economics, which actually takes it from about a pure 0.35% tungsten to about a 0.45% tungsten and a bigger bubble. So you actually lift that up a little bit towards that right-hand corner. So perhaps for some people it shades Shandong. But to have that in the portfolio, we think is hugely advantageous and a good time for tungsten presently. So just to conclude, look, we think we have a really strong platform, this combination of immediate production, cash flow, strong infrastructure, and well-funded to deliver that growth and take advantage for the Greatland platform. So with that, I'll hand back to Donald and we'll tackle those questions.
Thank you very much, Shaun. That was very interesting. Interesting also that you ended on O'Callaghans. O'Callaghans has completely caught people's attention. Now, we've got questions from a range of people. Nick Taylor, Dipsard, George McKenzie, Jonathan Dixon, and John Steele. They all ask about pretty much every question you could imagine on O'Callaghans. So the tungsten mineral resource estimate has been published. It's been fantastically successful. Would you consider having a tungsten division as part of Greatland? Have you had any interest from outside companies about possible mining of the deposit? Or even a JV? Might you divest the tungsten asset altogether? So pretty much from start to finish. And I would like to know, that potential isn't particularly in the share price yet, so that's something exciting, another reason to hold Greatland, really. So over to you.
Look, thanks, Donald. I did jump into the supplementary slides there just to give the context to O'Callaghans, because we did chat before camera that there was a question on O'Callaghans. And look, I think for us, interestingly, look, O'Callaghans was always a really interesting part of this transaction. We did actually try to buy in a previous life O'Callaghans off Newcrest back, I think, in 2008. So it's always an asset that I think has been intriguing because it really is this.
Was that when you were at Northern Star?
No, that was prior to that, but Straits Resources it would have been. But it's a world-class tungsten asset. And so, look, for us, I think we've brought out this resource update, I think, into a very strong tungsten market. But we started the work on this 6 months ago, to have that JORC ready, because we wanted to daylight this asset for shareholders so they understood the potential sitting within their portfolio of assets. Look, there's a range of what we could do with it. I guess at one end of the spectrum, we have our tungsten division. Perhaps at the other end of the spectrum is we spin off Greatland Tungsten. Perhaps we can be more imaginative with the name. But there's a range of outcomes in between, joint venture developments, or indeed a divestments, and we have had some inbound interest on that. Look, to be open with you, Donald, and for shareholders, look, we remain really focused on delivering at Telfer and Havieron. Mm-hmm. That's our first, second and third.
That much is clear, because you're so delivering on your focus.
But having said that, I think if there's a pathway where we think we can realise value for shareholders, and it could be anywhere within that range of outcomes, I think that's, of course, we'd consider that. So I think it's an active file for us. And it's great to have that opportunity within the portfolio.
You must have, a gut feeling about where you might land, though. Do you want to share that gut feeling with us?
Well, I think what I can maybe add there is if we didn't have the growth profile we had, if we didn't have Havieron, if we didn't have the West Dome underground, if we didn't have the potential sub-level cave, and there's even other opportunities like the Southeast Hub on our portfolio in our existing mining lease, which is a series of higher grade but smaller open pits. I think there's a lot of gold and copper to keep us focused. If we didn't have those, perhaps developing a tungsten division would be more attractive. I think it's probably looking at either a partner or some other way where we can demonstrate value without necessarily distracting our team from our core mission.
Okay, good question for Peter Goodman. Still sticking with tungsten. What do you expect the O'Callaghans development costs to be? How much is it going to cost? What's the potential timescale for a net positive cash flow? I think Peter might be disappointed with the second answer, but not with the first one.
Yeah, look, I think in terms of O'Callaghans, again, this is a really advanced tungsten project. Newcrest did a great job. They fully drilled it out. It was not just resource for Newcrest, it was also reserve. They did a 1,100-page study on it back in 2014. So although I'm familiar with the 2014 CapEx numbers, they seem modest by today's standards. So I think they're going to kind of, as we roll that forward, I'm sure it's a meaningful. I think it costs less than a Havieron to deliver, and also we think it can leverage that existing. It's closer to Telfer, so less road, less infrastructure to put in. It can take advantage of the bitumen airstrip, take advantage of the gas pipeline, or perhaps the electrons that we already generate. So I think there are some really good ways to expedite it. It sits on a mining lease. It already has an Indigenous land use agreement. So I think if there was conviction to progress this, it's almost shovel ready, but there's no doubt you'd have to spend time, energy and effort to update that study and reset. Equally, tungsten prices have really shot up, so I think it creates a very attractive environment to do that. And it's also around by value, say 10% copper, and copper's also a really attractive pricing. So,
would it be open cast? Would it need its own mill?
It's an underground asset, so think of it as a slightly more shallow Havieron. But look, you could consider taking advantage of that Telfer mill, but we're so confident that we have gold and copper ore to fill that Telfer mill for a long time to come. I think you ultimately need to develop its own standalone O'Callaghan processing capability.
So my hope is to just ask you some really big questions at the start to whet people's appetite. And here's the big one from Barbara Wilson and a few others. They all point to the Telfer-Havieron combination as a solid platform for growth, as you've outlined. And you were using language such as extraordinary, which is not very Shaun language. So I'm thinking it must be really good. But what would is it going to be organic growth, as you've already outlined? Is it acquisition? And are you going to stick to your knitting? Will it be copper, gold, copper, or possibly tungsten, or frankly anything else? And would you even consider going beyond Australia?
Yeah, look, I think our initial focus, again, we think we have such a strong organic, particularly on that gold copper portfolio. I think that is, as we presently see it, that is the highest way to deliver, highest order way to deliver value to our shareholders. I think anything that takes advantage of that Paterson footprint, that Paterson infrastructure, we continue to be interested in. So we're active in terms of how we think about that. But I think what you've seen with that delineating another 8 million ounces, having 550 million tonnes across 14.9 million ounces, plus copper, I think really has, I think a lot of shareholders would remember the original narrative in the market when we first acquired Telfer, mind the gap. Telfer will close after 15 months. It's already meant to be closed. And it's still running both trains absolutely full. We still have 24 million tonnes of stockpiles at surface. If we stop mining today, we'd still have almost 18 months of mining or processing still to go. So I think that mind the gap is behind us. It's now how do we not just fill that mill, but what are the opportunities to actually make the ore that we're putting through the mill higher value? Typically either lower cost or a combination of lower costs and higher grades.
I can't remember the name, but someone has definitely asked, would you ever consider adding to the capacity, mill capacity at Telfer?
Look, I think all things come into the frame, and again with the platform we have, we have to walk before we can run, Donald. Yep. So I think we're a ways off that decision. I also think there's a hybrid there where do you consider a standalone plant at Havieron, for instance? Because we truck that ore 45 kilometres, but 55 kilometres by the haul road. There's a cost to hauling that ore. So again, perhaps an attractive way to expand Telfer is to actually create a standalone Havieron mill and free up capacity to focus on additional Telfer ore. So there's lots of ways in the mix.
Okay, that's a clever solution. Mike Harbour asks, he wants you to talk through the total gold stockpiles. He says that the 31st, you'll be very familiar with these numbers, 31st of March 2026, there were 22 million tonnes. Do you have a breakdown between the high grade and the low grade stockpiles?
Yeah, look, we do, and that's in our quarterly report. I think, again, if you look back at the narrative, people expected the high grade stockpiles to be fully depleted down to zero by December. I think at December we reported 2 million tonnes of high-grade stockpiles still, plus around 22 million tonnes of low-grade stockpile. Look, that will be part of our quarterly update, so I don't want to kind of front-run that, but we continue to think the operational productivity that we've achieved at Telfer allows us to preserve stockpiles by putting more of the fresh ore that we've mined through the mill. And we love the flexibility, the
blend, as you put it.
The blend.
Upping the blend.
Upping the blend. And we love preserving that stockpiles because that creates that resilience, that flexibility.
Gold sales lagged some way behind production for the first 2 quarters of FY26, but finally caught up in Q3. What were the reasons for the lag, says Mike?
Oh, look, there's not a particular lag. Look, when we do a shipment, ships do tend to be, well, they're bulk carriers. That's really around the copper, which contains some of our gold. So I think literally whether that sails on the 31st of December or the 1st of January has an impact on the accounting. It didn't impact the cash. So I think when people are looking at the free cash flow generation, I think that's normalised. But when you look at the accounting numbers, you'll see a little bit more revenue in the March quarter and you saw a little bit less revenue in the December quarter. But by March, it will be washed through, and certainly by the full year June accounts, it will all be washed through.
Okay. And I'm not sure if this does have huge impact, but it's probably worth asking about the Iran war. If there's a long, drawn-out conflict, will there be an impact on the Australian economy? And does Greatland get sucked into that in terms of inflation, higher energy costs, supply chain shortages, or as a gentleman called John referenced, diesel shortages and leaching acids, etc.?
Yeah, look, well, I think, with diesel costs, I think that can be inflationary across the world. That includes Australia, it includes the mining sector, and by extension, it includes our Telfer asset within the Greatland portfolio. So we're not immune to that. But one of the things that I think is really helpful for Telfer is it's gas. The power generation is gas. Natural gas from the Northwest Shelf. Australia, or Western Australia in particular, is the largest gas producer on the planet. We also have a domestic market for that. So gas is cheaper in Australia. It's cheaper in Western Australia than the east coast of Australia because we have a domestic requirement. I think it's 25% of production has to be kept for the domestic market. So although it's influenced by the international price, it is a different and typically lower cost market. That means that actual diesel as an input cost into Greatland is 3.8% of our cost structure pre-war. So really for the first 8 months or even 9 months of this year, it's around 3.8%. I expect that in the bottom half, like I've previously been in bulks, where diesel direct input cost is around 30 to 40% of your cost structure. So this is relatively modest. Having said that, part of the question was around general inflation. Most things, whether it's the groceries we buy from the supermarket or indeed the groceries we get delivered at Telfer, come by truck. So fuel costs do tend to be inflationary across the sector. I think we won't be immune to that, but we're probably a little bit more insulated than the average mine.
It's not keeping you awake at night.
It's not, and I think there was the second part of that question was around: do you expect to have diesel or other input? Do you think there'll be a shortage? No, we haven't seen that. So we're confident about that. We talk to our suppliers. I think it's a robust supply market, so we continue to be confident about that. But equally, it's a fluid situation. We continue to monitor it. We continue to think about contingency plannings. Feels a little bit like COVID in terms of, how would you reduce transport costs? How would you, reduce flights into site? But really, that's just been wargaming. We haven't had to implement any of that. If anything, we continue to see operations unfazed. And let me just link it back briefly to the previous questions on stockpiles. We have 24 million tonnes of stockpiles at surface, already broken ore. If we were to stop tomorrow, if there was a hiatus and you couldn't get diesel for 6 months, we would still be processing that ore. You'd see the impact of that because those stockpiles are lower grade on average, but we'd still be producing cash flow. And be one of the very few companies to continue to do that. So I think that also gives us a fantastic insulation, which is not unique, but just about unique to Greatland.
We've got 7 questions on the Havieron development questions. Sean Haggerty and Stuart Hines were the first. The EPA suggested tracking Havieron ore should only take place during daylight hours. What impact might this have on costs? And can you share any options that you may be considering?
Yeah, look, it's a good question. We saw some reporting, but what I would do is probably recommend people look at the EPA release. It was a positive release. What they said is they were effectively recommending the project to the minister. And we, as in Greatland, initiated the suggestion that right now we get an approval based on daylight haulage. We're not a bulk. We're only doing 3.94 million. I think we top at 4.3 million tonnes per annum. That's a very manageable amount of tonnage per annum. So to speak illustratively to that, if you did day and night haulage, you'd have 5 trucks, or you'd probably have 6 trucks because one would be on maintenance, and you'd have 10 drivers, 5 on day shift, 5 on night shift, and you'd haul 24 hours a day. If we go to all day shift, you'd have 10 trucks and 10 drivers still. So you have to buy an extra 4 trucks. You do maintenance on the back of the clock. Obviously, we'd rather not acquire an extra 4 trucks, but these are surface trucks, relatively cheap, relatively long life vehicles. So it has an impact. We'd love the flexibility of haulage 24 hours a day, but we volunteered that to diffuse any concerns around the night parrot, and we've undertaken to do a 2-year study into that. If there were no night parrots there, we expect we'd be permitted to do 24-hour haulage, or perhaps if there is a small number of night parrots.
Strategically, in very Shaun fashion, you decided to nip that in the bud. Exactly
right, Donald. This was tactical to make sure the night parrot didn't delay approval.
Very wise, Shaun. Very wise. Right, they're now awaiting the Havieron approvals, awaiting ministerial approval. Do the state and federal government reviews, those reviews, do they progress in parallel, and how long might they take?
Look, Australia is blessed by 2 EPA approvals, both state and federal.
You're just very lucky.
They're very, they duplicate each other in large measure. That said, look, we've had a really positive engagement with both departments through that process. I think our team has done just a wonderful job in terms of engagement and managing that process. So we feel really confident about it. I think when you look at the market, people expect us to get EPA approval this calendar year. I like to think we've already been through public comment. I think a lot of people realise that. That means it's very well advanced. I'm a little bit optimistic about that approval process. And again, I think the team's done a wonderful job to put ourselves in that position.
Let's pull out and take an overview question about Telfer. Do you really think with that MRE, that cracking MRE, do you think you've put all the doubts about Telfer to bed, particularly amongst the institutions?
I think you saw some traction in the market, but I think the reserve update will be really important as well. But Donald, we'll be doing another 240,000 metres of drilling. I think only 110,000 metres were drilled before that 31 December cutoff. So I think the March 2027, which seems a little way away right now, but that's going to capture another 240,000 metres of drilling. So I think that's very exciting where we get up, and I think that will be...
And by that, you mean you're continuing to add to resource?
Correct, we continue. And I wouldn't suggest you extrapolate that. I think there'll be a lot of infill drilling, there'll be a lot of improving confidence around areas that we intend to mine. But I think there's, this is a continuum. I think as we complete that process and then in June 2027, complete the reserve update to reflect that, I think that's when you convince everyone. But I think we've convinced a number of people, but I think there's 12 months to go on that journey.
Great. Now, Dipsard was asking you about the reserve upgrade, but he also asks about the recent GDX and ASX 100 inclusions. How might they affect how Greatland is perceived?
Yeah, look, when I mentioned on the slide deck about we're listed in both Australia and London, and I think we hopefully did a good job communicating to the shareholder base why we felt the Australian listing would be beneficial, and part of that was this indexation. I think to have got into the ASX 100 so rapidly exceeds expectations. I think that was the first balance date that we could have been eligible on the ASX. So to go straight into the ASX 100 as Australia's third largest gold miner is extraordinary. In addition to that, we entered into the VanEck GDX, in addition to continuing to be in the GDXJ. So again, I think that vision, that intent to get additional indexation, to get additional relevance and additional credibility when we go into the US markets and places like that with institutional funds, I think is beneficial. And I think the second leg of that, although we've seen the initial index buying, I think the greater profile for the company, the greater credibility to get in that, the greater traction you potentially get with some of those big US funds, I think that's yet to play out.
Do you think in Australia you've been slightly underrated by the mining press, by the press in general, the financial press?
Oh, look, we're really comfortable with the engagement we get there. Of course, we think a little like your question about the journey on resource. We think there's still, I think we've kind of done a good job with that December 2025 feasibility study on Havieron to have a degree of price discovery on Havieron. I think there's still more work that we need to do and share with the market on Telfer to get full price discovery on Telfer. But in addition to that, we talked as part of the deck about these opportunities at West Dome Underground to expand the West Dome open pit, even revisiting the SLC. They will all be studies. They will be a series of final investment decisions, or of course not. And I think as we're able to delineate those to the market, I think they give additional catalysts where we can demonstrate value to the market.
So you see it as a good thing that you have these minor catalysts to kickstart things.
This is a journey, Donald, and look, no one's dying of boredom at Greatland. There's still much to be done.
Sean Kelly, what's the time frame from here for getting Havieron into production, and what will matter most in maintaining reliable performance during that transition period? Not a bad question.
Yeah, look, there's a lot of work to be done to deliver Havieron. There's no relax about the work that needs to be undertaken there. Look, Newcrest was a global major and had some struggles through that Permian. We have the benefit, of course, of having observed that, seeing what worked, seeing what didn't work. Feasibility so reflects the actual advancement rates they achieved. So I think it's incredibly beneficial to go into a new development having someone already done, a third of the work for you. Mm-hmm. Having said that,
is it only a third of the work?
Well, one decline 320 metres. By doing the second decline, I guess it's we need to do 5/8 of the work. And when we look at the other de-risking at Havieron, the fact that it's this brownfields project that comes back through that Telfer infrastructure, there's some surface infrastructure that we're building, roads, power lines, vent fans at surface, but there's a lot of float, and by float I just mean they're not on the critical path. We have an extra 6 months to deliver them. Of course there's a risk they're a couple of months late or cost 10% more, but they won't go to the critical path of delivering the project on time. What's on the critical path is that underground mining and development and ventilation system. That's really our focus. And as I said, it's a challenge. It's a $1.1, almost $1.2 billion project. That's a big project. It's important to us. We're focused on delivering it. But of course, what we want to do is get that EPA approval so we can start. But we are doing early works. We're quite active at site right now. And what we're trying to do is not necessarily accelerate that right now, but do a lot of work to allow us to go straight into a ramp up quickly. So the normal things that maybe slow you down at the start, we've already taken care of.
Great. Now, which flows really nicely into this question. Bamps asks, is the Havieron portal only going to have a short length enclosed with precast units? So short amount of precast units. Christian Olofsson hits the nail on the head. Christian from Sweden asks, in December, the Havieron main incline stood at 2,125 metres completed, 781 metres to go. Where are we now?
Yeah, look, in terms of, there's two parts to that question. The box cut, look, I think Newcrest and Greatland always had a difference of opinion about the Havieron box cut. It didn't contain a sump, so every time it rains, water's able to run down the decline. That's not good for an operation. It's not good for your road conditions, particularly when you're driving trucks up them that might hold 40,000 tonnes. We've actually effectively already, I talked about early works, we're already effectively going to portal that to surface where we create a concrete dome system structure that surfaces, and then we'll actually fill back in that box cut and remove that water catchment area. Where we think that de-risks the asset, it de-risks our development, but also over the years when we have rain events, we should be insulated to that. So I think that's a really important improvement we're doing, and we're able to do that now, Donald. In terms of the decline, we're not currently working on that decline. We are waiting for EPA approval, so we remain around that 320 metre mark. Just to remind people, the ore body itself, the basement rock, starts at 415 metres. So we're north of 75% complete. The second one will run from surface. Okay,
let me take you to the Telfer development questions. Interesting, 7 for Havieron and only 2 for Telfer. I'm not quite sure what that tells us, but it does tell us something. Richard Bell says, given the positive drilling results from West Dome Underground and VSC near mine resources, when could these be developed and when might that be relative to the current Havieron development? So how are you going to blend the two?
Yeah, no, it's a good question. Look, Havieron is this multi-year project, and we have a development schedule out in the market. Of course, we call that from day zero, which is the EPA approval, or more specifically, the company's final investment decision, which I think will follow in close order to the EPA.
Are you ready to go on the FID?
Effectively. It will need a board meeting though, so I think that's just the fuse. When we look at the in-mine Telfer, these don't need separate approvals per se. We're leveraging that existing infrastructure. We haven't made a decision to mine the West Dome underground yet. It's spectacular grade. It's just 2,000 metres off the existing infrastructure. Clearly, the nature of that question, there's an optimism that looks like it will be mined. But we're really just starting to do the mine planning work around that now. But that potentially can beat Havieron ore into the Telfer mill. I think that could be our next, the next source of new ore for the Telfer mill. So, we share the optimism around that. In terms of the sub-level cave and the vertical stockwork, the VSC, I think that would be a secondary focus for us. But again, it leverages that existing infrastructure. I think it gives us much the same opportunity.
Exploration now. 2 exploration questions. Interesting. Not so many questions about exploration, but you are going to spend rather a lot of money on exploration next year. Do you want to
Well, again,
mention?
a lot of that spending is what delivered the resource and ultimately the reserve. So that movement from 2 rigs in Telfer, both at open pit and in the underground, that's where the centre of gravity of our exploration effort is spent, and that goes directly to demonstrating life extension at Telfer. So we think that is extraordinary, adding extraordinary value for shareholders. We added ounces or delineated ounces at the cost of just $5 Australian an ounce in this latest drilling program. These are ounces that we were running at an observed cash margin of over $2,700 an ounce. So it is compelling to invest in exploration at Telfer right now. So we'll continue to do that, and that's that surge based on just the success that the team delivered. I think we just want to continue that for an extra 6 months.
But all these years I've been sitting down and talking to you about Ernest Giles, talking about Scallywag and so on. Do those get slightly blown away by this
We still have a really well-run regional exploration team. That team does a fantastic job for us. And look, we love the optionality that creates in the portfolio. They're the ones that will deliver the next Telfer, the next Havieron. And the option value for that is gigantic. But of course, the probability, you don't find 10 million ounce ore deposits every week. So look, can be a slow burn. You've got to kiss a lot of frogs, but you don't know which one is going to turn into the prince. It could be the next.
Right. So that question came from Ruben Cornwall and Steve Bridge. Very good question. And Ruben says that he's still holding his breath on Scallywag. When can he let it out?
Well, look, this is part of our regional. Look, we've tested some of the anomalies there. There is a number of high quality anomalies still there. And look, what all good regional exploration teams, they rank their anomalies that they want to work through. So look, there's still a number of highly ranked Scallywag anomalies in the portfolio. So I think we're about to sit down and do the FY27 budget, and I'm sure they're going to be part of that discussion.
If you weren't Greatland Resources, you'd be getting so much more excited about these regional exploration sites, don't you think?
Well, absolutely, but that's why you have the separate team, so you can have a team really focused on just delivering that option value.
But you still take it seriously.
Caught up at Telfer. Well, absolutely. We've actually increased the investment in that. It does get dwarfed, though, of course, by just that effort around Telfer and Havieron.
5 dividend and share price questions. Mike Harbour, Richard Lansdowne, Darren Jackson, and Andrew Wallace all ask about dividends and share buybacks. With more than 1.2 billion Aussie sitting in the bank account, it's inevitable you'll get asked about the prospect for paying a dividend at some stage, says Mike. What might a sustainable dividend policy look like, and would you prefer dividends to share buybacks? Now, there's a sensible question. Well done, Mike.
Look, right now, our priority is about delivering that growth. And I think you've seen the share price appreciation factored around just the strength of that organic growth profile, Donald, with the Havieron development headlining that, the improvement in Telfer resource and ultimately to translate into reserve and mine life, the West Dome underground, the West Dome open pit, the sub-level cave. So look, we think that is compelling. That creates the most shareholder value. And I think we have such a strong balance sheet, this 1.2 billion plus the flexibility of another 500 million of debt. I think that's given the market confidence that we can deliver and that there can be some twists and turns and we can still deliver there. So that's our priority. Having said that, I'm typically a dividend kind of guy. Straits had a dividend policy. Sakari had a very high dividend policy. I think a payout ratio of 60% of net PAT. Northern Star was also a dividend payer. So, my track record is paying dividends. I think share buybacks are also attractive. The Australian market, which has an imputation system where you basically frank your dividends and you pay back tax that you've paid to shareholders, can distort the Australian market, which makes dividends a little bit more attractive than share buybacks. But I think both are good, both would be considered, and ultimately we want to move to having a capital management policy. But the very first top of the list of that is to deliver those growth projects.
You presumably got lots of things still to run at, and if it weren't organic growth, then presumably, we've not talked about this, but wouldn't there be the possibility of acquisitions as well?
Look, of course, I think the quality of that exploration outcomes, in terms of that delineation of JORC resource, what it potentially does to the reserve, and then we've talked about what it might be by March 2027, I think makes us feel really confident about what we already own and the life extension that we have. But look, if we can be opportunistic and look at things that we can add, I think that's always going to be attractive to us, particularly where we can leverage existing infrastructure, but it's hard pressed to find things better than we currently have. But
it does make a great solid platform for growth, as people talk about.
Well, and that's part of the beauty, not just, we talk a lot about our operations, but the Greatland platform more broadly is obviously a platform, it's better recognised in the market, and that gives us the opportunity to be more broader in terms of how we think about opportunities for growth.
Let me ask you how the institutional shareholder base has changed in Australia and the UK over the last year, and how supportive of acquisitions it must be to have Wyloo in the mix. We've not talked about Wyloo.
Yeah, look, I think, if you have a look at Greatland, look, our home is here in London. That's where we started. We have, we think a really strong retail base here, but we also have a really strong institutional base here in London. I think if you compare it to our peers, we are overweight, weighted in the portfolio of London and indeed some continental fund managers. And I think that reflects our history, our pedigree from the London market. The opportunity for us over the last 12 months was to add the Australian market to that. I think we've done that really well. We're very similar to our Australian peer group, maybe a little bit more growth that we can still achieve there, and add some new names. And again, the ASX 100 entry just gets us on the radar of a lot more funds.
Is it 50-50 between the UK and Australia?
In terms of, it's actually now slightly more weighted to Australia, but both markets are working extraordinarily well. Even though there is a little bit more of the registry in Australia, the liquidity in London, the daily trading volumes are very similar. So both markets are working really well. I think we're getting the best of both worlds, and we continue to respect and value the support we get.
Which takes us exactly to Steve Bridges' question. How do you feel the cross-listing has gone? Are the ASX shares and CFDs as fungible or interchangeable as you would like them? There appears to be a delay between selling on one and being able to trade them on the other. But there you go. He's asking about the cross-listing and so on. And that distribution of shareholdings between ASX and AIM. And is there a general migration one way or the other? But from what you say, it seems...
It seems reasonably balanced. There is, the ASX continues to grow modestly, but both exchanges are really strong. There is the ability to fund from either market to the other. Computershare, we use the same share register in both markets. That's, I think, quite an efficient system. It's not instantaneous, but it should be kind of done almost same day. So I think that does make them really transferable between the two markets, and we see some both ways flow.
Let's go to Shaun and Havieron. What milestones over the next 12 to 24 months do you believe will drive the biggest re-rating of the share price?
Yeah, look, I think we've just got a range of catalysts coming up. Obviously, our full quarterly report is ahead of us in the month of April. We'd like to deliver that June reserve upgrade, the June quarter reserve upgrade. I'd love to be announcing the EPA approval for Havieron, subsequently the FID. I think we have opportunities to announce, make announcements around that West Dome underground, perhaps the big cutback on the Stage 7 West Dome open pit. And then of course at some stage we're updating the resource again and the reserve cycle. And you know, we could wait till March 2027, or we also consider interim updates as well. So I think these are all, you know, I think we are catalyst rich over the next 12 months. I think beauty's in the eye of the beholder a little bit. I think some will gravitate to one announcement, others to another, but I think there's something in there for everyone.
Well, they've all kick-started the share price. The last three announcements you've put out have all been winners.
Well, they've been, I think, tremendous news. I don't think it was a surprise to anyone, the amount of drilling we were doing around that resource, but I think the outcome was extraordinarily good, and I think surprised on the upside. If you look at the outcomes we're getting in terms of cash generation, again, I think it's exceeded the street's expectations. And then the ounce profile in terms of what we've delivered, 250,000 ounces in 9 months. Again, really good operational outcomes we're achieving.
How can you keep exceeding expectations though?
Well,
every time you sit here, you exceed expectations.
Yeah, look, it's a good problem to have, but look, the team's doing a mightily good job. Really appreciative of it. You know, there's 550 odd people at Greatland who all play their role to an extraordinary high level to deliver what we achieve together.
Now, let me ask you. I've been itching to ask this question all day. The Greatland share price, for me, I often see it as a proxy for the gold price. Now, given the strength of the Greatland fundamentals, do you find that frustrating? And why do you think gold didn't act as a safe haven asset? It has for the last year or two and done extraordinarily well, but then it certainly didn't during the let's get this correct, the US-Israeli war against Iran. Very important to remember Israel, which must have caught out lots of investors. What do you make of all that? You're sort of an expert and sort of inside the whole thing. What do you make of it all?
I think you know, during the first Cold War, you saw gold really be a barometer of geopolitical risk. Between Cold Wars, you saw gold become large, you know, mostly negatively correlated with real US interest rates. I think as we've gone into another Cold War, I think what you've seen is gold reassert that barometer of geopolitical risk. In terms of kind of what happened with you know, the Iran war or Gulf War 3, I think what happened there was a confluence of factors. And you saw gold come off a little bit, but we are literally talking about gold moving from its March price down to its January price. So it looked quite stable from where we were sitting, but I understand people monitor daily movements. That said,
it depends if you'd lost 10% of your holding, that's all.
Well, true, but I think we're at an all-time high share price, so you've done.
That's what happens.
You've done all right. But I think where gold didn't kind of necessarily go up, because you might say, well, if it's correlated to geopolitical risk, I think was two factors, as I understand it. Firstly, we talked about diesel being inflationary across the economy. Well, I think that made people feel with higher inflation, you're likely to have higher interest rates. Again, you see that negative correlation to the real US interest rates. So I think that probably put some downward pressure on the gold price. But in addition to that, you had this kind of shock event in the market. Gold was liquid. People were in strong positions. The soft feedback we get from brokers is there was some, hey, I've made a lot of money in this stock or in this physical gold, I'll take it off the table. That's why you just got that 5-10% dip and then steady.
Forced profit selling.
Yeah, and it can be people are called on, something else, and they have to kind of redivert funds. So that's a little bit the narrative I hear, but I think actually gold's been, done its role in some ways. It's been a good store of value through an uncertain period.
You wouldn't say no to $4,800 an ounce, would you?
Oh, it's a spectacular price, and that's not to say it won't go up higher, and it's not to say it can't go down either. It continues to be a commodity, and that's why we take out those put options. It's nice to have insurance. I equate it to my home insurance. My house has never burnt down. I don't even know anyone who's had their house burnt down, but I still have house insurance. So, we do the same with our gold price, and that also gives us operational protection, because if the gold price changes, it's just invaluable to have that extra 12 months over other people where we don't have to make operational changes. We can take our time and be considered to make those changes operationally.
Which is part of why gold copper is such a strong platform for Greatland.
Well, correct. And I think if there was a frustration for me, sometimes people don't recognise the value of the copper in our portfolio, perhaps not even the tungsten in our portfolio. So, but we are gold copper. So, and copper has been going tremendously.
We're going to
as
have
well.
to start talking about you as gold, copper, tungsten, aren't we?
Yeah, perhaps.
Even you will have to do that. Okay, I've got a really fantastic final question. Thank you, Tony Kingston, for what is a great question. Many of us, I'm sure he says, have probably formed a bit of an emotional attachment to Greatland over the years. Well, maybe we have, but never had the opportunity to actually see it up close. If we could make our own way to Western Australia, would it be possible to accommodate a group tour to see Telfer, Havieron and the night parrots? There you go, Tony Kingston. Is he going to get a holiday or is he not?
Yeah, no, let me answer that in two parts. I think even if you were there, you're not going to see a night parrot. They are notoriously hard to see. But look, I think more
I don't
broadly,
think he's really interested in the night
No,
parrots.
I appreciate that. But the look, I think we're as delightful as it would be. It's not a tourist attraction. There are safety implications. And it is an inhospitable part of the world. It's a dry area. People shouldn't take lightly going out there. So we obviously have the infrastructure around camp, but look, it's not something that we'd necessarily be able to accommodate visitors, which is a shame.
Oh, that is a shame. I thought you were going to say yes, so there you go.
No, it's a little bit off the beaten track.
It's a bit too hard to do because it's a tough old place and it's just not that. It's a business and not a tourist site.
Yeah, it's also there are safety implications and permitting requirements to do things like that.
Shame. I thought I was going to end on a happy note, but it's a slightly sad note. Shaun, it's been fantastic as ever. You're literally a mine of information. I don't know how you keep these numbers all in your head. It's completely wonderful. Thank you so much. Well, it's been a real joy, and a pleasure. Now, that's it from us. We're truly out of time. A big thank you to Shaun for travelling from Australia, at least in part, to engage with retail shareholders. Thank you to all those who took the time to ask Shaun a question. Thank you. The calibre was really good. He and the team are off to meet the shareholders at the in-person town hall meeting next. But for now, thanks for watching, and we look forward to doing it all over again next time. Thank you.